Hello traders. In this lesson, we are going to talk about another important lagging indicator, the Bollinger Bands. This indicator is obtained by a combination of moving average and standard deviation. I will open the Bollinger Bands indicator. A new window will open in which we can adjust the parameters of the indicator. Period 20 tells us that the indicator will use a simple moving average of 20, meaning 20 periods. I won't talk much about it. As I explained the moving average in the previous lesson, deviation 2 means standard deviation 2. If you don't know what standard deviation is, I'll explain it now. I will turn on the indicator first. Now, as you can see, there are three lines moving around the price. This middle line represents the simple moving average fan thing. The upper line represents 2 positive standard deviation, while the lower line represents 2 negative standard deviation. Let's just say something about the standard deviation. The standard deviation is a differentiation from some average value. So if this period represents 100% of a certain value, X represents its average value. The standard deviation of 1, that means -1 to 1, is the range in which the most value points that deviate from this central value are located. This means that 683% of all observed data will be in this range. From -1 to 1, the standard deviation of 2, that means -2 to 2, tells us that 954% of the total observed data will be in this range, while the standard deviation of 3 to 3 tells us that of the total observed data, 997% will be within that range from -3 to 3. What does all this mean for us? I will now change the input for deviation. If I enter 1 instead of 2 and click on box 1, what does this indicator tells us? It tells us that in 68.3 of the time, the price will be within the indicator, while the rest of the time, which is 31.7%, will be outside the indicator. If I enter number 3 as a deviation input, then the indicators tells us that the price will move within this indicator 997% of the time. So almost always, only here we see a small break through of the upper line of the indicator. Traders generally use standard deviation 2. So we'll enter deviation 2 as well. Now, the indicator tells us that the price will move within this indicator 954% of the time, while only 46% of the time the price will spend outside this indicator. We see a breakthrough of indicators here, 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 and down here. The assumption of this indicator is that there is a good chance that if the price breaks the lines of the indicator, that the price will return to its frame very quickly, because the price is on average within the indicator 954% of the time. So, to conclude, the simplest signal provided by this indicator is when the price breaks the upper line of the indicator. Then we have a sell signal when the price breaks the bottom line of the indicator. Like here, we have a buy signal, because we believe that the price will return within the indicator very soon. Now, this seems very simple, and in this example, this indicator would bring us good profits. But as you know, the market is very unpredictable, and we cannot always expect a nice sideways movement like here. Let's see what the situation is. In a growing trend, would we have good results? Maybe we would, but only if we were opening buy positions whenever the price hits the upper line of the indicator. As a rule, we have a sell signal But look here, the price constantly hits the upper line of the indicator, but it continues to rise. So we would have a lot of losing trades in a growing trend. We can use the bottom line. It gives us a buy signals. We had this situation here, here again, and also here we had a good buy signal. There is another important rule related to this indicator, it states that we can expect a strong upward trend if the price is for a long time located on this upper line or upper standard deviation. In this example, this has happened several times, but after that there was a turnover, the price started to fall, of course. Although this indicator is good, it cannot always give reliable results. Here even we can see that the price has long stayed at the bull standard deviation. There has been a reversal and fall. There is another signal that this indicator provides, and those are narrows. One narrowing we have here, and the rule that applies to it is that after narrowing there will be a sudden decline or growth. We cannot never know for sure whether there will be a decline or growth, but the assumption is that if the price was a growing trend before narrowing, then it should be continued, as it happened here, at least in the short term. We have this situation in this example as well. Indicator has narrowed, and after that we can expect a sharp decline or growth. In this example, there was a growing trend before narrowing, and it continued after narrowing. Well, this would be some basic rules in trading with Bollinger Band's indicator. See you in the next lesson.